Welcome back to Smart Stock Sam, where we cut through the noise and give you the analysis that actually matters. Today, we are doing a complete deep dive on SoFi Technologies, everything you need to know before its earnings drop on April 29th. We are talking about the catalyst breakdown, the short seller war, the trade setup, and the one single number that will decide whether this stock doubles or falls off a cliff. So buckle up, because this one is going to be a ride. Now let me ask you something. What if I told you a company could post its single best quarter in its entire history? Record revenue, profitability, institutional validation, and still watch its stock get absolutely destroyed? And what if I also told you that right now today, you might be staring at one of the most significant valuation disconnects in the entire fintech sector? That is exactly the situation playing out with SoFi Technologies. The business is objectively on fire in the best possible way. But the stock price? Also on fire, in the absolute worst way. Here is the big picture of what is happening and why it matters to you. On one side, you have record-breaking fundamentals. On the other side, you have market sentiment that has turned completely toxic. The result is a staggering divergence. We are talking about a year-to-date decline of nearly 42%. Wiping out the majority of last year's remarkable gains. And yet, underneath all that red, the business itself is executing at a level we have genuinely never seen before. Most investors look at that number and panic. The smart money is looking at the gap between what the business is doing and what the market is pricing in, and asking whether this is a historic opportunity or a value trap. That is the central question we are going to answer today. So let us look at the actual numbers, because the gap between business performance and stock valuation is almost hard to believe when you lay it out side by side. As of today, April 12, 2026, SoFi is trading at $16.22. That represents a 41.8% decline since January 1st. Now, normally, when a stock drops 40% in a few months, you open the earnings report and see the business falling apart. Revenue collapsing, losses mounting, guidance getting cut in half. But look at what actually happened. Q4 2025 revenue came in at $1.01 billion. That is 39.6% year-over-year growth. Think about that for a moment and really let it sink in. The company is growing its top line at nearly 40%, and the stock has fallen by nearly the same amount in the opposite direction. This kind of widening gap between operational performance and stock valuation either means the market knows something catastrophic is coming that the revenue numbers have not yet revealed, or we are witnessing the setup for an absolutely explosive rebound the moment sentiment shifts. And here is the context that makes this even more striking. If you zoom out to the full prior year, SoFi was actually a top-performing fintech name, delivering total returns somewhere between 50 and 70%. It was a darling. Analysts loved it. Retail traders loved it. And then 2026 showed up, and the retracement was nothing short of brutal. So the question every investor is asking right now is, why did the music stop? The answer comes down to three major catalysts that hit like a wrecking ball. The first, and by far the most damaging, was the Muddy Waters short report released on March 17th. Now, this was not your typical valuation is stretched critique. Muddy Waters made a specific and serious allegation that SoFi is engaging in aggressive accounting and financial engineering around its student loan gain-on-sale reporting, but the most alarming claim was about net charge-off rates. They alleged SoFi's personal loan charge-off rate is actually running at 6.1%, nearly double the 2.89% that the company officially reported. If that accusation is true, it fundamentally changes the risk profile of this entire business. And that uncertainty alone was enough to send institutional sellers to the exits. On top of that, you had the geopolitical shock in March, when tensions from the US-Iran conflict triggered a broad risk-off rotation into safe haven assets. Consumer finance stocks took a beating across the board. And layered on top of all of that is a sector-wide reset driven by persistent interest rate uncertainty that has compressed multiples for nearly every name in the consumer lending space. Those three forces colliding at once created the perfect storm that took SoFi from a market darling to a punching bag in a matter of weeks. But here is where it gets genuinely interesting, because if you set aside the noise and focus on the hard data, SoFi just crossed a milestone that every analyst has been waiting years to see: $1.01 billion in quarterly revenue. That is the first billion-dollar quarter in company history. And the bottom line? EPS came in at 13 cents, 1 penny ahead of consensus estimates. This is no longer a growth at all costs story. SoFi is now growing the top line at nearly 40%, while simultaneously delivering profitability. And critically, it is not just the quantity of revenue that is changing, it is the quality. SoFi has been intentionally pivoting toward a capital-light, fee-based revenue model, and that fee-based stream is up 50% year over year. That combination, revenue scale, earnings leverage, and a higher quality revenue mix all at the same time, is exactly what separates the real businesses from the ones that just burn cash and hope the market keeps giving them a pass. And there is something else that undermines the short seller narrative in a way that is hard to ignore. In late March, right in the middle of all this chaos, SoFi announced $3.6 billion in new loan platform partnerships with major institutional counterparties. Think about what that means. These are not retail investors making a quick bet. These are institutions with entire teams dedicated to credit analysis and due diligence. They do not hand $3.6 billion to a company whose underwriting is broken or whose charge-off rates are secretly double what they report. That deal is arguably the most powerful rebuttal to the muddy waters thesis that currently exists. Now let us talk about what Wall Street actually thinks this stock is worth, because the analyst range right now tells a fascinating story. The current price of $16.22 is sitting below even the most bearish price targets on the street. Firms like Barclays and Wells Fargo have slashed their targets down to the $17 to $18 range, essentially saying the near-term risk-reward is unattractive. But JPMorgan Chase is standing completely firm with an overweight rating and a price target of $31, citing SoFi's long-term potential as a fully integrated digital financial platform. The consensus average target across all analysts is $25.09. When a stock is trading below the bear case, the market has essentially priced in a disaster scenario. If that disaster does not materialize on April 29th, the path toward that $25 average could move very, very fast. On the technical side, the picture is honestly still bearish in the immediate term, but there are early signs that the selling pressure is exhausting itself. The stock is trading well below both its 50-day and 200-day moving averages, which are acting as significant overhead resistance and will need to be reclaimed before any sustainable uptrend can develop. However, the RSI is sitting at 49.77, basically neutral. We are not overbought. We are not in oversold panic territory. More importantly, the MACD is beginning to curl slightly positive, which historically signals an attempt at trend stabilization. The volatility that defined the March sell-off also appears to be cooling. The blood in the streets phase may be ending, and the stock is quietly trying to find its footing. And here is a structural dynamic in the market that you absolutely need to understand. Short interest on SoFi currently stands at 13.16% of the float. That represents over 165 million shares actively betting against the company. The days to cover ratio is 4.15. What that means in plain English is this: if SoFi delivers a positive surprise on April 29th, it would take roughly 4 full days of average trading volume for all those short sellers to buy back their shares and exit their positions. That mechanical buying pressure, forced on them whether they want to or not, is the structural foundation for a potential short squeeze. All it needs is one catalyst to light the fuse. Looking at the options market, we can see exactly where the institutional battle lines are drawn. On the downside, there is a massive put wall sitting at $16, with approximately 57,000 contracts, and another layer of support at $15. Market makers are required to buy shares to hedge those positions, which effectively creates a floor. On the upside, there is heavy resistance concentrated at $17 and $19, the levels the stock needs to break through convincingly before it can regain real upside momentum. Right now, the price is pinned right up against that $16 support. It is a coiled spring, zoom all the way out, and the long-term investment thesis has not changed at all. SoFi is building a financial super app ecosystem, one platform for lending, banking, investing, and financial services for a digitally native generation. The projected EPS growth for 2026 is triple-digit, and importantly, Vanguard has been actively accumulating, now sitting on approximately 107 million shares. Vanguard does not accumulate 100 million shares in a company they think is committing fraud. Their position implies a belief that fair value is somewhere at $24 or higher. That is the long game playing out in the background while retail investors panic over short-term headlines. So what is the actual play right now? The posture is patience. We are in a strict wait-and-see mode because the April 29th earnings call is the single most important event in SoFi's recent history. Management will be forced to address the muddy waters allegations directly, on the record, with institutional analysts asking the hard questions. The $16 level is acting as a firm floor, validated by both options positioning and institutional buyers stepping in. We are holding the line, but we are not charging the hill until we see what comes out of that call. If you are looking for an entry point, the setup looks like this. The entry zone is right where the price currently sits, between $15.80 and $16.20. That aligns directly with the put wall support we identified in the options data. Your first resistance target on the upside is $18, which is where the more cautious analyst targets cluster. If the stock breaks convincingly above $18, the next target is $21, a retest of the breakdown level from the prior technical structure. To protect your capital, a stop loss at $14.90 is essential. If SoFi breaks below $15, the bearish thesis gains serious credibility, and you want to be completely out of the position before the damage compounds. And that brings us to the binary moment that everything is building toward. On April 29th, there is really one number that rules them all: the personal loan net charge-off rate. If that rate comes in below 3%, the muddy waters report is functionally demolished. The short thesis collapses. The path toward a re-rating to $24 or $25 opens wide. But if the rate validates the short sellers' fears and prints above 3%, the current support levels will not hold, and the downside risk becomes very real. The fundamentals say this company is a generational fintech platform in the making. The sentiment says it might be built on shaky foundations. On April 29th, one number settles that debate. Before we wrap up, an important disclaimer. Everything discussed in this video is purely for informational and educational purposes only. Nothing here constitutes financial advice. And Smart Stock Sam is not a registered financial advisor. Always do your own research, understand your own risk tolerance, and consult a qualified professional before making any investment decisions. Investing in individual stocks involves significant risk, including the potential loss of your entire investment. So there you have it. The complete SoFi picture heading into earnings. Watch the $16 floor. Watch the charge-off rate on April 29th. Watch what happens when 165 million short shares have nowhere left to hide. And watch whether JPMorgan or Muddy Waters gets to say, "I told you so." Now I want to hear from you. Do you think the Muddy Waters report is a legitimate red flag that the market is right to be terrified about? Or is this the most overhyped short thesis in fintech this year? Drop your answer in the comments below, because I genuinely want to see where this community stands before April 29th. By the way, I have provided my analysis on these accusations. You can find that video in SoFi Stock playlist. If this breakdown helped you cut through the noise, hit that like button. It genuinely helps more investors find this content and keeps the channel growing. And if you are not subscribed to Smart Stock Sam yet, Now is the time, because the April 29th follow-up reaction video is going to be unmissable. Stay disciplined, stay curious, and I will see you in the next one.